This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 14, 2026, and this is the Tokyo session. Now, let's get into it. The U.S. economy just tripped over its own feet. July retail sales didn't just miss estimates, they collapsed to minus 0.6%, shattering the plus 0.1% forecast. That 0.7 percentage point gap sent shockwaves through the dollar index and ignited a fresh wave of speculation around Tokyo. As of 9:32 Eastern Time this Friday, August 14, 2026, the dollar is bleeding across the board, and the yen is waking up. It's a classic stagflation trap snapping shut. We have growth stalling at 1.5% annualized, yet inflation is sticky at 3.3% CPI. The Fed is stuck at 3.63% rates, unable to cut because of prices, but unable to hold firm because of the labor market, which just saw a 23,000 month-over-month decline. This policy paralysis is the engine behind the current dollar weakness.
Technically, that engine is stripping gears. Look at dollar-yen. It's sitting at 159.369, right in the throat of its 5-day range, which spans from 157.84 to 159.57. The pair touched 159.506 earlier today, that psychological resistance, and got rejected immediately. We're seeing a compression fracture here. The move down isn't a smooth slide. It's a series of stops and starts against heavy overhead supply.
And that supply is crowded. Leveraged funds are drowning in yen shorts. Their net position is minus 60,825 contracts. They've added over 61,000 shorts in a single week. This isn't a fundamental bet on Japanese monetary policy. It's a crowded carry trade unwinding. Every pip lower in the dollar forces these funds to cover, creating mechanical buy pressure that ignores the macro reality.
Let's connect the dots. Pulse identified the stagflation trap as the driver, and Grid mapped the 159.5 resistance as the bottleneck. But CIPHER is telling us that the path of least resistance isn't just downward, it's volatile upward due to forced covering. The retail sales miss of minus 0.6% didn't just weaken the dollar, it trapped billions in yen shorts at these levels. The structure is fracturing because the positioning is unsustainable.
That brings us to our first stop on today's agenda. Before we dissect the majors, let's look at what's scheduled to keep the market on edge. Today features the already released retail sales shock we just discussed, alongside business inventories. Looking ahead, Tuesday brings U.S. industrial production, and Thursday, we face the RBNZ rate decision, which will be critical for the Kiwi and broader risk sentiment. Apex, what's the priority here?
The priority is monitoring the reaction to Thursday's RBNZ decision against the backdrop of today's dollar bleed. If the retail sales miss already priced in a soft US landing, the RBNZ becomes the variable that either validates or invalidates the global growth slowdown narrative. Watch for any divergence between Kiwi strength and yen weakness. If both rise, it's pure safe haven rotation. If Kiwi falls while yen rises, the risk-off trade is accelerating.
Let's dig into the headlines moving the needle right now. First, Canadian data showed manufacturing sales for June came in at plus 0.1%, beating the minus 0.1% estimate. Meanwhile, the broader narrative is dominated by the dollar nudges lower on the day amid mixed market mood and reports that U.S. stocks hit records, but oil and earnings risks are growing. Finally, there's chatter about 3 reasons why BOJ rate hikes will not save the yen, even as the currency strengthens. How does the Canadian beat fit into this?
Canada's manufacturing beat is noise in the wind tunnel of the U.S. data storm. While Ontario is posting positive prints, the U.S. consumer, the global demand engine, is contracting. That minus 0.1% estimate versus actual plus 0.1% in Canada doesn't offset the fact that U.S. services and goods consumption are rolling over. In the hierarchy of macro data, U.S. retail sales trumps Canadian manufacturing. The signal is coming from Washington, not Ottawa.
But Pulse, you're missing the volatility risk. The VIX is at 14.55. That's not just low, that's dangerous complacency. We have a 70 basis point miss in retail sales, yet volatility hasn't spiked. The market is pricing this in slowly. When the VIX is this compressed, as it is in its 5-day range of 14.39 to 16.3, any subsequent data surprise, like the upcoming industrial production, will cause a disproportionate jump in spreads. The calm is artificial.
Let's zoom in on the biggest mover, dollar-yen. It's at 159.369, down 0.4% on the day. Grid, you're calling the technical breakdown here. Walk us through the levels.
Dollar-yen is testing the lower bound of its recent action. We've had a tight range between 157.84 and 159.57 over the last 5 days. Today we pierced 159.506, tried to hold and failed. The close at 159.369 is below the midpoint of that range. If we lose 159 cleanly, the next liquidity pool is the 5-day low at 157.84. But here's the rub, the candles are getting smaller. Volume is drying up at these lower levels. That usually precedes a snapback, not a crash.
Snapback is exactly what I'm watching. Grid, you see small candles, I see trapped shorts. Those leveraged funds are down 60,825 net. They are underwater. As price grinds toward 159, they aren't closing positions voluntarily. They are waiting for a relief rally to reduce losses. The moment we touch 159, we'll see algorithmic cover buying. It's not a reversal of trend yet, but it's a reversal of momentum.
Hold on. Both of you are assuming the downside is inevitable or that the bounce is guaranteed. Look at the fear and greed index. It's at 14 out of 100. That is extreme fear. Usually, extreme fear leads to capitulation, not stability. If the VIX stays at 14.55 while the dollar falls, we're seeing a divergence. The market isn't fearing a crash, it's fearing stagnation. That means dollar-yen could drift sideways at 159 for weeks, grinding the shorts dry without giving them the sharp rally CIPHER wants, or breaking grid support without the volatility spike SPECTER fears. The low VIX is masking the true risk of a slow bleed.
SPECTER raises a valid point about the regime. Grid's technical barks and CIPHER's short squeeze theory rely on high beta, but if the VIX stays suppressed, this becomes a low-volume grind. The retail sales miss removed the catalyst for a violent break. Without a new catalyst, like the RBNZ decision, we might just see dollar-yen oscillate between 158.5 and 159.5, boring traders into submission. The breakdown Grid sees might just be a retest of 159 as new support, not a collapse.
Moving to euro-dollar. It's at 1.1537, up 0.3%. It's hovering near the middle of its 5-day range, which ran from 1.1512 to 1.1566. CIPHER, you mentioned earlier that the euro also has heavy short positioning. What's happening there?
Euro positioning is almost identical to yen, but with a twist. Leveraged funds are net short 52,205 contracts. However, look at the asset managers. They are long plus 219,262. There's a disconnect. The speculators are betting on euro weakness due to ECB dovishness, but the institutions are accumulating. This makes the euro fragile but potentially explosive. Unlike the yen, where everyone is short, the euro has a wall of institutional buying just below these levels. That makes a short squeeze less likely and a slow grind up more probable.
Fragile is the right word. Euro-dollar is stuck in mid-range stagnation. At 1.1537, it's nowhere near the 1.1566 resistance or the 1.1512 support. The daily candles are tiny. There's no conviction. Pulse talked about the stagflation trap affecting the dollar, but Europe is showing similar GDP growth of 0.4% Q2. Why is the euro stronger than the dollar if the economies are mirror images? Because the dollar is being punished for the retail sales miss while the euro is just standing there. Technically, that means euro-dollar is range-bound until the 1.1566 level is challenged with volume.
It's not just mirror images. The ECB is constrained by the same energy prices and sticky core inflation as the Fed. But the U.S. has the added weight of the debt ceiling and fiscal uncertainty looming in Q4. The euro's strength against the dollar is actually just dollar weakness. Don't mistake a sinking boat for a swimming one. The euro isn't going up, the dollar is going down. That distinction matters for your entries grid.
Let's talk about cable. It's at 1.34947, up 0.4%. It seems to be handling the dollar weakness better than the others. CIPHER, what do the flows say?
Sterling is the outlier. Leveraged funds are net long plus 38,174 contracts. That's bullish. While everyone else is shorting the dollar or shorting the euro, pound buyers are actively defending the 1.345 area. This isn't a squeeze, it's genuine demand. The UK economy is showing resilience, and unlike the US, there's no major data missed to punish it today. The flow is consistent with the price action, steady. Supported bids.
Visually, cable is hitting the upper boundary of its 5-day range. We're looking at 1.3474 to 1.3546. The current price of 1.34947 is approaching that 1.3546 high. Yesterday it failed to sustain a break above 1.3513. Now it's trying again. If it clears 1.3546, we're looking at a new structural break. But if it rejects again, which it has done twice this week, we'll see a flush back to 1.34. The risk is asymmetrical here. A break to the upside opens room, but a rejection locks it into a tighter box.
And don't ignore the cross risks. GB pod is at 1.9112. If risk appetite dies completely, as suggested by that 14/100 fear and greed score, the Australian dollar, which is correlated to commodities and risk, will fall harder than the pound. So while cable looks strong, it might just be buoyed by a collapsing Aussie. That's a synthetic strength. If commodity prices wobble, that plus 38K long position in pound could become exposed quickly.
So we have a trifecta of movements. Dollar-yen is caught in a technical jam with crowded shorts, euro-dollar is stagnant due to symmetric macro fears, and cable is finding genuine flow support. The common thread is the US retail sales miss. That single data point is the gravity well pulling the dollar down, but the direction each currency takes depends on its positioning. Yen and euro are fighting their shorts, pound is riding its longs.
Finally, let's address the elephant in the room, gold. Gold is at 4,324.39, down 0.74% on the day. It's rebounding from a 5-day low of 4,311, but still far below the 4,450 high. SPECTER, you warned about complacency. Is gold acting like a safe haven or a speculative asset?
Gold is doing neither properly. It's trading at 4,324.39, which is up from the lows, yet the CFTC positioning is net bearish at minus 670. This is a dead cat bounce. The fear and greed index is at 14, which should be sending money into gold. Instead, the smart money is still short. The low VIX of 14.55 means nobody is hedging. If equities correct sharply, gold will sell off initially as margin calls hit, regardless of its safe haven status. Treat any rally in gold as a trap until the CFTC flips positive.
Technically though, the 4,311 low held, that's a key support level for the 5-day range. The rejection at 4,450 was hard. Now we're consolidating between 4,311 and 4,350. Until we break 4,350 with volume, the path of least resistance is sideways. The 0.74% drop today suggests profit-taking after the initial spike, not a trend reversal.
Agreed on the 4,311 floor. The institutional buying isn't in gold right now, it's in yen and pound. Capital is rotating out of the non-yielding asset gold and into the yielding/stable currencies, yen via BOJ talk, pound via resilience. Gold is being sacrificed to fund the margin requirements for those other trades. Watch for gold to lag until the dollar stabilizes.
We're running low on time, so let's bring it home. Apex, synthesize the key takeaways for our Forex Edition listeners.
Here is the strategic picture for Friday, August 14th, 2026. First, the US retail sales miss of minus 0.6% has created a structural headwind for the dollar, but it has also trapped leveraged funds in yen and euro shorts. Second, technical ranges are compressing. Dollar-yen is failing at 159.5, Euro-dollar is chopping at 1.1537, and cable is testing 1.3546. The lack of volatility in the VIX at 14.55 suggests these moves will be erratic, not linear. Third, avoid chasing the dollar-yen breakdown. The short squeeze mechanics CIPHER highlighted mean dips are likely to be bought. And finally, respect the pound strength. With plus 38k net longs and no negative data surprises, sterling is the only major showing true fundamental resilience against the dollar backdrop.
Key takeaways: the dollar is weak due to the retail sales miss, but positioning is extremely crowded in yen and euro, creating squeeze risk. Pound is outperforming on genuine flow strength, and gold's rebound is suspect due to bearish CFTC data and low VIX. Tomorrow, watch for U.S. industrial production and the ongoing RBNZ buildup. Stay tuned, stay sharp. This is ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.